The next thing we're going to look at is short interest. Most stocks have a short interest between 2 and 4%. Unfortunately, we're going to have to do this calculation manually or find another site that will give this information to us. So we will do this by hand. So the total shares outstanding are 316,236,278, and we will divide that by the short float, which is 316,200,000. That gives us a short float of less than 1%. What we're looking for is a stock that has a relatively small float. If the short percentage of float is over about 4%, we are in jeopardy of a short squeeze. If the underlying asset begins to move up, then the traders that have short positions will flood the market with buy to close orders, and that will continue to push that market up. If that is likely to happen because the short float to the short interest is excessively high, we want to know that before entering the trade. This particular stock is okay because the short interest is fairly low. We'll move on to the analyst recommendations tab. We will scroll down and see what analysts are currently recommending versus what they've been recommending for the last 1 and 3 months. Note that recommendations haven't changed that dramatically. Most analysts have either a buy or a hold recommendation. Take a quick peek at insider trading. We can see for the last several months there has not been a lot of insider trading. The activity most recently was in March and January of 2010, where there have been some sales, but nothing within the last 4 months. Earnings, this is critical to check because we don't want to hold one of these income trades through an earnings report. The next earnings announcement is scheduled for September 1st, 2010. This is good because if we want to make a trade for August, we'll be out of this trade well before the earnings event. Next, we'll take a look at news. And there's 2 sites that I look at for this. First, we'll look at Google. And if this is a stock that we haven't traded before, what I will do is read all of the major news events over the last 12 to 18 months. I want to know what's going on in this stock. I will also look at the Reuters site, and I will scan these news events to make sure that there's nothing that could adversely affect the price of the stock that is known currently. And it's okay. Everything here looks good. Of course, if I was doing a real trade, I would spend much more time. We're only spending about 10 minutes here to do our analysis, but if I was going to do a real trade, I would spend at least 30, and if this was a new stock, I would spend several hours reviewing all of this information. This looks good for a demonstration trade. The last thing we're going to check is volatility on this stock. So we have 2 options. We can either go to a site like ivolatility.com, or once again we can put in our symbol and click the volatility button. What this functionality in our software will do is load historic data for Heinz. It will analyze all of the price movements in the last 12 months and give us calculations for the statistical volatility over a variety of periods. Note that the current 30-day statistical volatility is 16.45%. This is the same type of information that you can get from myvolatility.com. But this software will also show you the statistical volatility values for other periods other than 30 days. For example, we have a 20-day and a 10-day, and then going longer, we can see over the last 3 months we've had a volatility of 20%. We will use this information in conjunction with the current implied volatility of these options contracts that we want to trade to determine whether this is a good time to do a trade at all, whether we should be doing a trade like a covered call or a short put, we should be doing a time spread, something like a long calendar or a long diagonal or double diagonal, or we should be selling Vega and doing something like a butterfly, either narrow or wide, or a condor. So we'll use this information along with this volatility chart to make that determination. Now normally when volatility is low, this is a good time to enter a long Vega trade. And when implied volatility is high, for example, when it peaked here in the second week of June, this was a great time to enter a position that would benefit from a decrease in implied volatility. This is the most difficult time to trade. when implied volatility and historic volatility for that matter are in the middle of the range, we don't really know whether it's going to move up or going to move down. Best thing to do is be conservative and just sit out of the market. However, for the demonstration purposes, we're going to go ahead and build a trade if we can. So here's what we're going to do. We don't want to take a chance that implied volatility is going to go up unexpectedly. So we are going to identify a fairly high number in the range that implied volatility has traded in within the last 6 months. Note that the range of historic volatility over the last 6 months is between 16% and 20%. So we're going to try to build a position that will make money as long as volatility doesn't increase above about 18.5 to 20%. So to do that, we're going to click the highest point. This is the volatility for the 3-month. Note that when we clicked that, the width of these 2 points increased. So if I click this at 15.9, note that the range contracted, and when I click this point at 20%, note that this range expanded. What we're doing here is what the software is doing for us is calculating the range of 1 and 2 standard deviations based on those selected volatilities. So at 20% volatility, the market of course isn't at that. The market's currently at 16, but if the volatility of the market, this stock in particular, increases to 20%, then there's a 68% chance that Heinz will be within the range of $41.91 and $47.05 at August expiration. That's 3 weeks from now. So what we want to do is build a trade that will take advantage of the probability that the underlying asset will be within this range. Now we will couple these 2 points with our analysis at the very beginning where we identified the support and resistance levels. Remember that we identified 43 and 47 as levels of support and resistance respectively. So we're going to build, and knowing now that underlying assets volatility can increase all the way to 20% and we still won't be outside that range on the upside, we are going to use the 47 or the 47.50 strike as our upper bound, and then something close to the 42.50 or 43 if it exists as the lower bound for our position. To build this trade, we're going to go back to our paper trading account. We will put in the symbol for our new stock, and we'll try to build a simulated trade with about 3 weeks till expiration. Fortunately, Heinz has strikes at $1 increments. So we're going to first look at selling the strike at our lower bound and buying some downside protection for that. And then on the upside at 47, we're going to look at selling and buying. This is a red flag to us because of that differential. What we have now is a stock with a slightly upward bias. What we're doing is we're using the 43 points based on our technical analysis. 43 should be a level of support. In fact, within the next couple of weeks, that 200-day moving average should come back up near the 44 points. Let's take a quick peek of that chart just to reconfirm. Here's our Heinz chart again. Note that we have support at 43 and that the 200-day moving average is approaching the 44 points. So we should have some reasonable support in the 43.5 to 44 level. So we will use that 43.5 to 44 as a backstop in case the underlying asset wants to continue moving down. At least it will slow in this area and it will help prevent us from losing too much money. If the broader market begins to move very quickly, then we'll have to step in and adjust this position or close it and take a small loss. This position has a maximum potential profit of $12 and a maximum potential loss of $88, although we'll never let that happen. What we want to do is build a position where we have about $1,000 at risk. So what we're going to do is increase the number of contracts to 11. That gives us a position with a maximum potential profit of $132. Our strikes are well placed. We have a position that will cost us $968 to enter. We'll monitor this every day or two and make any adjustments that are necessary. However, the closer we get to expiration, the less practical an adjustment will be, and in the vast majority of cases, it's simply more appropriate to close a position or roll to the next month than it is to make any adding any additional hedges to the position. To open this position, we will right-click, create a duplicate order, select a price that we believe can be filled, and confirm and send. Today is Saturday. The market won't be open for 2 more days. If you're going to enter a position like this over the weekend, what you should do is analyze the market and the underlying asset before the market opens, look at the current futures prices, and determine whether the market is going to gap on Monday. What you don't want to do is enter this position now and learn Monday afternoon that the market has gapped and you're now in a bad position. So take a few minutes Monday morning before market open and reassure yourself that this is a reasonable position per the current market situation. I'm going to go ahead and click send, and we'll check this position on Monday to see if we get filled. If you haven't signed up for our market and portfolio updates, please do that. Provide your first name and email address. You'll be on the mailing list and you'll be notified a few times a month when we make adjustments to positions or close and take profits. If you have any questions or comments, please let me know. Good luck with your trades.